Hey, before we go to calls, we got a couple more calls coming. There's been quite a bit in press lately about private investments coming into your 401k. So the 401k allowing for things outside of publicly traded securities or interest-bearing accounts, which is what you have today, right? In 401ks.
All right, so what would be a private security, Scott?
Well, for example, a private credit fund.
Okay.
Okay. And what this really means is, I was having this discussion the other day with a friend of mine, talking about how the private markets have filled this void that the bank could have filled.
You know, Scott, you bring up you talk a lot with your friends about this stuff. Is it the one friend that listens to you constantly, or do you have multiple friends?
It's not really a friend. It's a rent-a-friend.
Is it? Are you bragging?
I pretend like I'm talking to a friend. No.
It's a chat bot.
I was having a conversation on a bike ride with a friend in the last week or so about these private markets. So we all know how banks work, right? You need to get a loan. You've got a business or whatever. You go to a bank. They look at you. They loan you the money. Today, there are a lot of, let's say, medium-sized businesses that are borrowing money not from the banks, but through these third-party companies that are structured to provide this financing. So, for example, some of KKR has entered the space. BlackRock has entered the space. And the way these things work, there are private companies that will go out and raise capital from insurance companies, endowments,
pension plans,
wealthy families. So they raise
sovereign wealth funds.
So they'll raise X amount of dollars through this, and then people have an opportunity. They'll create these
big
loans,
big pools.
They'll create these loans to XYZ business that is maybe couldn't get traditional financing from the bank.
And many of them, those businesses are backed by what they call either venture capital or private equity.
That's correct. So it's a means to provide the financing. And the interest rates are typically fairly high because these companies, they're not publicly traded. They're not Microsoft or Apple that have great credit ratings. They're private companies themselves. So the interest rates are quite high. What we're starting to see now, though, is a push for these investment opportunities to more individual investors in 401k plans even.
So not just accredited investors, which is you can become an accredited investor if your income is over a certain level, or your net worth is over a certain level, or if you're a professional investor. You can become an accredited investor and you have access to these, with the assumption being because you're an accredited investor, you understand the risk and the rewards of that particular investment.
Yeah.
But they're trying to widen the funnel of who can invest in these.
Yeah. And so you're going to start seeing in 401k plans in the not too distant future, these opportunities to invest in private credit or private equity.
And they oftentimes will go be labeled alternatives. And the alternative is, the word alternative means alternative to the public markets.
That's right. Typically, yes.
Right.
This is an area that you need to be very careful in tipping your toe into.
Scott, I believe that the reason these alternatives, the private credit, the public private equity, have become so large is because of the regulatory environment on the public companies
and the banking institutions.
That's right.
Yeah, so all the regulation that came down after the financial crisis hamstrung the banks in a lot of different ways.
That's where the private credit came in to fill that void.
That's exactly right. I don't even know how small the private credit market was before, but I think it was pretty nascent, and now it's quite mammoth. And there are places for it in people's portfolios for private equity, private credit, other kinds of funds. There are places, but once you start seeing your 401k, I'd be kind of careful about it. Just tiptoe into them.
Correct. Especially these marketplaces that are relatively new, because a lot of this private credit doesn't have huge histories behind it.
That's right. We haven't gone through a financial crisis.
That's right.
Or a really prolonged downturn.
So don't get enamored by the yield, because the
yields are going to look great.
They're going to look good, right? But remember, typically the higher the yield,
the greater the risk.
That's why they have to pay.
A company wants
yield.
to go borrow some money. The bank says, "Well, sorry, we can't loan it to you because you don't have any real assets to back it." So they go to the private markets, like, yeah, we can loan you the money, but it's gonna cost you 12% a year.
Yeah, and then the private credit company takes a slice of that, and then puts out the yield to you.
That's right. The company themselves, they'll take a slice, and then they'll charge a fee.
Yes,
to syndicate all this, put it all together,
and then. The idea behind distributing inside 401ks is actually to create a greater funnel. But I believe,
there's some regulatory people say, well, this is more democratization, giving people the access to these private markets. I'm like, well, how about just loosen the regulations on the public side?
And enforce the ones that were in place. Yeah. Because the problem with the financial crisis wasn't the lack of regulation. It was the lack of enforcement of the regulation.
And the government backing of all these loans.
Well, because they weren't underwriting they weren't underwriting the loans. The government had given up underwriting the loans.
That's correct. It didn't even matter.
They didn't even follow their own guidelines. So, but the pendulum will swing. The pendulum will swing. As they loosen the regulation in the public markets will become more vibrant, and then the private markets will shrink. Yeah. It's just how it's going to work. I mean, this is the nature of the world.
That's right. That's not where we are today.
It's not where we're at today. But this administration has every intention of loosening up on these the regulatory environment. In many places, way too much. Way too much.
Well, I'm a huge believer in free markets. I actually, the older I get, the more I just think it's a beautiful structure because it allocates capital to the right places, assuming we all play by the rules, we know what the rules are. And if I sit down with my family to play a game of Monopoly, we know what are the rules behind the game. There's certain rules, and as long as we all play the rules, that's fine. Someone ends up taking Park Place and Boardwalk. I haven't played Monopoly in a decade or so, but I think most of us have played Monopoly. It's by the rules. It's the same thing in the marketplace. Free markets work great as long as we all know the rules and follow the rules. Know the rules and follow the rules. And to your point, enforce the rules and not ignore the rules for.
And why did you use that Monopoly? That brings back just so many bad memories.
You'd hide the $500 bill underneath, so that people think you're broke when you actually have the cash.
There was never a game that didn't end up in a fist fight with my brothers.
Okay, well, a fist fight.
No, a fist fight.
A fist fight.
Because it came to the rules, and then all of a sudden
someone's trying to cheat.
And then next thing you know, someone's throwing, and then the couple of the neighborhood kids, and